we're going to be speaking about gold, the price of gold, and we're also going to be speaking about gold miners, not the people that dig underground and pull the gold out, but the companies that pay them sometimes to do that. And so that is the topic of today's. I am really delighted to be joined on today's webinar by an analyst that many of you will know. He has been publishing to trading forums for many, many years. He is known as SilentOne. And I must say, when I was developing Center and started working with Hurst cycles, I used to read his analysis, and I found it extremely useful. His name is John, and he is joining us today. Before we say hello to him, I'd like to give you a little bit of a sort of personal background to how John's analysis of the gold mining sector has contributed to my own trading success fairly recently. I've had the great fortune of getting to know John over the years. He's been involved with SilentOne from the very early days, since we were developing the Hurst, and he was involved as a beta tester on the Hurst Trader, and he's provided fantastic guidance in how SilentOne traders should approach its analysis and so forth. I've also had the pleasure of developing a friendship with John over the years, and we've exchanged analysis over the years, what we think is happening. And I'll say that whenever John says that he thinks something is happening in the markets, I sit up and take notice. And I have an example of that, actually, that has to do with gold and the gold mining sector. Here it is. As a South African, I'm really interested in gold because there are many gold mines in South Africa, of course. It's a big part of the economy in South Africa, and I have various South African trading accounts, and I can trade the gold miners in South Africa. In late November last year, John saying that he believed the gold mining sector was due for a turn up, and I should look at getting into some gold miners. And here is Gold Fields, one of the gold mining companies from South Africa. You can see I entered into a great trade at the beginning of December. That green line represents the from the entry to the exit, a perfectly timed trade, a really great trade, and it was due to the fact that had been alerted to the possibility that gold mines were turning up. And here's another trade that I took at the same time in Anglo Gold. As a matter of interest, at the time, John said to me that he felt that the gold mines would turn up, but it wasn't going to be the big turn up, because there was going to be a bigger turn up, a bigger trough forming that was coming later, and I should expect price to pull out of this trough. It did, and as you can see, I took a profitable trade in Anglo Gold over there. Got out, just started moving down. John warned me to expect it to move down into the middle or late of next year, this year, 2015, and that is exactly what it did. Before we speak to John and hear what he has to say about gold and the gold miners, we need to, of course, please take a look at these disclaimers. They are very important that you have read and understand these disclaimers. Let's get to speak about gold and the gold miners. Before I ask his opinion with us, I'm going to give you a little bit of a sort of a really big overview about gold and you know, how one takes a Hurst cycles approach to gold. So here's a chart that goes back 200 years. This is the gold price going back 200 years. And you can see way back at the start of this chart, I don't know, it depends how good your eyes are. Let me see if I can turn this pen on. Here we go. Let me find the stylus. There we go. Okay. So over here, this is 1792. That's a yellow pen, which isn't a very clear color. Let's change that to blue. This is 1792. Now, 1792 is an important year in terms of the gold price, because it is the year that the United States dollar was linked not only to gold but to silver. It was what was by metallic standard, where the value of the United States dollar was directly linked to both gold and silver. And what that meant was that the price of gold and silver was also linked. And so if you had a coin that weighed a certain amount in gold, then the same coin that weighed the same amount but was made out of silver would be worth 1/15. The ratio was 15 to 1. And of course, both those metals were then linked to the value of the US dollar. You can see interesting little blips over here. The blips are mostly caused by wars. It's an interesting discussion, but we won't have. And here's the Civil War over here, where again we had a big blip. In 1834, the price of gold changed slightly because the ratio between gold and silver changed from 15 to 1 to 16 to 1. Then in 1873, which is about here on this chart, there we go. In 1873, the US dollar was delinked from silver, so silver was taken out of the equation, and we started what has become known as the gold standard, of course. And so the US dollar was linked only to gold. And it continued to be linked to gold until the Great Depression. Here you can see the Great Depression. The Great Depression started in 1929, I beg your pardon, and carried on until 1935. I see we have somebody there who's not seeing any charts. Let me just check whether you are seeing this chart, or are you seeing something else? Let me just switch here and see if that is working. Okay, several people are not seeing the charts. Okay, David Trading Hurst can see the charts fine. And David Preston can see the charts. Okay, so yes, okay. I'm sorry that some of you might not be seeing the charts. Charts are okay. Okay, I'm going to keep going. I'm also strangely not seeing a preview of the charts. Sometimes you have to leave some software problems to other people, and I'm afraid this is one of those times. So I'm going to keep banging on. Okay, you can as well on Chrome. Oh boy, so we've got one of those problems. I tell you what, let me just do a reset of this, and let me just stop sharing this, and let me share it again. Let's see if that will refresh it. You should be getting a message saying that you're waiting for my screen. That. Let's see whether that refresh has worked. Okay, I hope you should all be seeing a chart. I'm seeing it in my preview. It's still okay for David Preston, and Stuart's okay. What about some of those people who couldn't see it before? Are you seeing it now? Okay, I'm getting confused in the chat window. Still okay on Firefox. We have to worry about all the different browsers, of course. Okay, so I'm just going to keep speaking. Hopefully that technical problem is resolved. So where was I? Right, the Great Depression. Seems a suitable time to mention software problems. So the gold standard for gold continued. In other words, the US dollar was linked to gold right up to the Great Depression. And in fact, many people blame the long period of the Great Depression on the fact that there was a gold standard. In other words, the United States dollar was linked to the price of gold. And so that's an interesting little point. At that time, during the Great Depression, the gold standard, as it was at the time, broke down. And towards the end of the Second World War, 1944, there was the Bretton Woods Conference in the United States, where the gold standard was reintroduced, but it was called the Bretton Woods Agreement. And it was an agreement not only to link the United States dollar to the price of gold, but also the currencies of several other countries, and of course to link the currencies of those countries to each other. And so it was a sort of a mass manipulation of currencies relative to gold. It was a kind of gold standard, of course, because it was linking everything to gold. But it was called the Bretton Woods period, or the Bretton Agreement. And then the next point of interest is this dashed red line over here, which is 1971, which is when the gold standard In those days, it was called Bretton Woods, but it was abandoned, and gold was allowed to trade freely. So this chart that we're looking at is, of course, a standard price chart in that, the higher you go up the Y scale, the more expensive the instrument is, and of course you've got time at the bottom. So you can see that in 1971, when gold was allowed to trade freely, it started looking more like a normal price chart. Okay, let's take a slightly closer view. Here's a chart of the most recent 100 years, and you can immediately see the problem as a cycles trader. Before the gold standard was lifted in 1971, in this period over here, there is no price action that we can base any kind of cycle analysis upon. So the only cycle data that we have, or real price data that we have, is following 1971. And so that's the first problem when you are going to be analyzing gold, is what are your longer cycles? And here's the first really point, and I'm going to get John in a moment to speak about this, because when you are analyzing gold, do you use the same nominal model? Do we work with the same list of cycles that you use for stock markets? Hurst, in the Hurst Cycles course, in fact, dedicated an entire chapter to a discussion of gold and suggested that gold works with a different nominal model to stock markets in general. And so John did a lot of work to determine what is the best nominal model to work with. And he has come up with a nominal model. And I'll give you a bit of detail before we actually ask John about it. I know that initially he started working with some silver prices because, of course, the silver price was detached from the US dollar way back in 1873. You've got 142 years worth of silver data that you can use to extract those prices. But is there a definite relation between silver and gold? Clearly both precious metals, but are they entirely related? We don't know. The next chart I'm going to show you is a little dark. I hope that you can see this. It's a chart published by William Randall on the Hurst Cycles site, and it shows us the price of the GC futures, which is gold futures, gold price futures. And this shows us data from 1985. This is 1975 at the left, all the way up to 2015. I think that's when this chart was. And at the bottom here, you can see the evidence of the cycles. I'll just point an arrow to it, and you can see that there are 7 cycles there. 7 cycles in how many years is that? I think it's 38 years. So so those 7 cycles average out at about 7.5 years. So there is clear evidence that there is a cycle between about 7 and 8 years in length in the price of gold. And potentially, of course, there are longer cycles. Well, we know there are longer cycles, but what are those longer cycles? And so at this point in his thought process, John has explained to me, he then started looking at the gold miners. Now, gold miners are obviously the companies that pull the gold out of the ground, and they provide us with a really interesting situation because their stock prices, the value of their companies, is closely related to the price of gold, clearly. Okay, but they are also companies. They are also stocks. Stocks in those companies are stocks. I'm talking myself in circles, but they are part of a stock market, and so they sit in an interesting position. They straddle gold price and the stock market, and so I'm going to now ask John to say hello and explain to us the nominal model that he came up with as a result of looking at many years of data. Isn't that right, John? You went all the way back to 1920, I believe, using a stock miners index.
Actually, it was 1940.
1940. Okay.
Yeah. So what I started with was I was looking for the longest data set for the gold miners, and that lies in the Barron's Gold Mining Index, which is commonly referred to as the BGMI. And so
Right.
taking that data set and putting that into Sentient, and then running an initial cyclic model, so giving it no Hurst nominal model. I ran it a number of different times from different start points to try and find the larger cycles and see what would come out of the data. And so the model that you were showing or just now, that is pretty much the
Yeah.
basic model that I've been using as how should I say, as an expert model, if you will, or the reference model for Sentient when we look at the analysis today.
Okay.
So
Okay. So can I just highlight one or two of the points that you mentioned there? First of all, the concept of an initial cyclic model, ICM, for those of you who don't understand what that is. Here is the price data that John is speaking about for BGMI, Barron's Gold Mining Index, and it goes back to, well, the data he worked on goes back to 1940. So it's a very good long data series. And Sentient Trader, when it performs an analysis, uses, of course, a nominal model. And if you wanted to, if you want to experiment or try to develop your nominal models, then what you do is you tell Sentient Trader to perform an initial cyclic model analysis. So what it does is it puts more emphasis on the spectral analysis that it performs at the beginning of the analysis process. It puts more emphasis on that, and it uses cycle lengths, are still harmonically related, but are more directly a result of the spectral analysis, rather than pinning the analysis, if you like, onto the default nominal model. So that's what John did, and he came up with this nominal model that we see over here. This is the cyclic model table. The longest cycle is a 14-year cycle. The next longer cycle is a 7-year cycle. Again, it's called a 7-year cycle, but the wavelength is 7 and 8 years, about 7.5 years. Then we have a 3-to-1 harmonic ratio to the 42-month cycle. And John, I'm correct in saying you find the 3-to-1 harmonic ratio works better than a 2-to-1 harmonic ratio there?
Yes, I think when this model basically came out of Sentient, I looked at a lot of the different cycle periods, and I could identify cycles that I would often trade in the past. So the 14-month is again, it's going to be a range of 13 to 14 months, but it is a very strong and tradable cycle, as is the 30-week and a 15-week. So I would disregard the actual numbers in the second column, but really focus on the nominal model of the first column, and that is pretty much the model that I was using for this. And if you were to simply input Hurst's nominal model into Sentient and try to run the analysis, you would get completely different results. You would not get very consistent results, and this is actually really the main point.
Yeah. Okay. So that's a really important point. That of course the nominal model that Sentient Trader is using to perform the analysis is critical to make sure you're getting the correct analysis. I've just written the numbers 18 up there because the 14-year cycle is really the equivalent to what we're used to calling the 18-year cycle in Hurst's nominal model. And then the 7-year cycle is the equivalent to the 9-year cycle and so on. So we're looking at cycles that are running shorter than our standard nominal model. That's the important point there. And we can take a look at this nominal model, of course, in Sentient Trader. I hope you know that you're able to share charts in Sentient Trader, and if you perform an analysis with a particular nominal model, then of course that nominal model travels with the chart. So John simply emailed me his workspaces, and here we can see his nominal model. So I don't know if you can see that there. There's the 14-year cycle, the 7-year cycle, the 42-month cycle, 14-month. We get from the 14-month cycle, we get the 30-week cycle. So the 30-week cycle is equivalent to what we are used to thinking about as the 40-week cycle. So effectively, all of these cycles are running shorter than they do in a normal stock market. Now, remember that what we're speaking about here is the Barron's Gold Mining Index. So it is also a stock index because it's the index of gold mining companies. I see Marcus says the heading here says silver. Yes, that's just the heading of the nominal model. When the nominal model was created, it was created with that name. So presumably John uses the same model when he's analyzing silver. We can maybe get to that in a moment.
Correct. Yes,
shorter than the 30-week cycle. Yeah, okay. Shorter than the 30-week cycle, we've got the 15-week cycle, then the 53-day cycle. Now, that 53 days sends shivers down my spine. Perhaps I'm unusual, but the number of times that you see a 51 or 52 or 53-day cycle forming, particularly I've noticed in gold and in many commodities of that interest, but that's a separate subject really. But it's really interesting to see that cycle here in the nominal model. Because one sees evidence of it all the time. Shorter than that, we have the 26-day cycle, then the 13-day, then the 7-day, and all the way down to the 3.5-day down there at the bottom. And so let's start taking a look, shall we, at an analysis. Yeah.
I just wanted to add just one more comment about the peaks versus troughs view on the sector.
Yes.
Right. So
yes.
Traditionally I prefer to analyze gold with a peaks analysis, and I think that is reflected in the fact that gold will spike in a fear type of manner, similar to the way stocks make important lows on spikes down. So I think that an analysis, peak analysis of gold works best for the metal. But when we look at the miners, because the miners act very much like stocks at times, particularly when the liquidity is low and markets are correcting hard, you will see gold stocks correcting substantially. So this is why I actually prefer to use a trough-based analysis for the miners instead of a peak analysis for gold, which is a bit odd, but I just find that that really does work best. So go ahead, David.
Okay, fantastic. And of course, in the new version of Sentient Trader that we've started beta testing, you'll be able to see both on the same chart, but we won't be doing that today. So, so that's an important point, that the gold mining company analyses, or the indexes, we're analyzing with synchronized troughs, and gold price better analyzing with synchronized peaks. I see Sid said, could I ask whether I could turn on the phasing loops arches? Is that what you mean, Sid? Hopefully that's what you mean. So here is analysis of the Barron's Gold Mining Index, and if we take a look, I've got some charts over here on some static images, makes it a little bit easier. The bottom line, as you can see, is that the Barron's Gold Mining Index is coming down into a really big prominent trough, which is a trough, of course, of 14 years. So let's go back to Sentient Trader and let's have a look, and we can start exploring this analysis. Here is the 14-year cycle low, which was in 2000. And if I count the bars, you can see if I bring it right up to today, although these bars are monthly, we're looking at 14.83 years. So, so this cycle is running long, isn't that right, John? The cycle is running longer than would normally be expected.
It is getting now to the long end, yes.
Okay, so because that cycle is running long, obviously we're expecting it to turn around fairly soon. Let's zoom in and have a look at the next shorter cycle, which is the 7 to 8 year cycle. And let me just change this chart to a weekly chart, so we get a little more resolution on the data. There we go. And if I measure that up to you'll see that's 6.85 years. So again, we are approaching the time for that cycle to reach its end, if you like, and so we're definitely heading down towards that nest of lows. If I keep moving in and we take a look at the most recent, what is this, the 42-month, and measure that there, then you can see at present is that.
Yeah, I would probably add the comment now about the current 4-year cycle and how it made that rally in 2012 to a very short and important peak in the summer of 2012.
Let's take a look at that. Okay, yes, let's take a look at that, and let's introduce you. I'm going to introduce you to a concept that John introduced me to, the concept of an cycle inversion. Cycle inversion is something that you don't often speak about in Hurst cycle terms, because Hurst didn't really talk about the concept of a cycle inverting. So I had to ask John to explain to me what it meant. A cycle inversion occurs when an important peak occurs at about the time that in fact you were expecting the trough. Okay, so here you can see the 42-month cycle. We were, let me choose a color for this pen. We were expecting the month cycle trough to occur during this period over here, and what happened was we had a peak. That, of course, was the highest peak that we've seen in the past 4 years or so, a little over 4 years. So that is what John speaks about as cycle inversion. Okay, so we were expecting it, but we got a peak. Okay.
Exactly. And
another way, perhaps, of looking at it, yeah.
Yeah, I was just going to add that event was quite bearish.
That event is really bearish, and there's a logic behind why that event was really bearish in Hurst cycles terms. You should all know that if you get an early peak in a cycle, that of course is a very, very bearish indication, and so you could also call this a failed cycle, could you, John?
Yes, exactly.
Because it bounces out of its trough, forms a very, very early peak, as you can see, and then heads south. So the formation of that peak at that point was a very early, very bearish sign. I wonder whether maybe we're going to see something similar happen in the stock markets. We're expecting a long cycle trough, and if we end up getting a peak there, then we're going to be looking at a failed cycle. But let's not get distracted into that discussion here. So there we had a failed cycle, or an inverted cycle, and then let me just turn this pen off. There we go. And then if we zoom in again and take a look at a bit more detail, and perhaps I can change this to a daily chart. No, the daily chart, it's quite a thin data series. Okay, there we go. So if we have a look at that, let me see if the semicircles work
So,
here at the
so
scale? Yeah, they do.
if I could add, David, then the first 14-month cycle low came in the middle of 2013, which was more or less expected. And then what happened from there was in the summer of 2014, in July, August, um, actually, not a similar time to when we were together, David. Um,
That's
this
right.
market peaked. This market peaked where I would have pretty much expected an important trough. And so again, you have an example of a cycle. This is the next degree down, but of a cycle making an inversion, if you want to call it that, but certainly a failure occurred, and we have been down from that peak ever since. So that's
Right.
two cycles on two different degrees that have failed. And you can
Yeah.
see that in this 14-month period to follow, we are down into whatever low is going to arrive. And then if you look at the next cycle down, which is roughly the 30-week cycle, I have a feeling that you're sort of seeing the same type of price action as a result. In other words, we should have had an important peak for most of the gold, an important low for most of the gold miners in that late November, December period last year. And that
Right.
rally in some indices was quite good, but in the case of the BGMI, it peaked again, and has been the peak for the current 30-week cycle.
Okay.
So
So
what
again,
would
we have an issue with a failed cycle. John, can you
yes?
get your microphone any closer to your? Can you get your microphone any closer to your mouth? I'm hearing you well, but I see some others aren't. I don't know if you
Yeah,
can.
I'm worried about doing too much because I've had trouble.
Okay. Okay. All right. So we've seen a constantly bearish sequence of cycles at smaller and smaller scale, and so the bottom line here is that the markets are heading down into a trough. They're approaching a trough, which is a trough of 14-year magnitude. Is that right?
Yes, correct. And so,
Okay, I
so the
suggest just
other,
quickly answering the question. Yeah.
yeah, so the other, I was just mentioning to Stuart that the data set has been kept by a site called Sharelinks or sharelinks.com, and it's a weekly closing data set, so it's not terribly robust, but it has been an index that's been around a long time.
Right. I see an interesting question
So
from
just
Would.
uh, so let me just
With
finish.
a bit of. Sorry, yeah,
Let me
carry on.
just finish with the idea of these failed cycles. So now, if you look at the current 4-year cycle, you have a failed cycle at the 4-year level. You have a failed cycle at the 14th-month cycle level. You have what appears to be a failed cycle on the 30 week. And so the net result of all that is, at some point, all these cycles are going to tumble into a very important low, and it won't be that far away, and that's pretty much what we should be focusing on from this point on.
Okay, so we're looking at a really important low coming up sometime, anytime, really from now up until early next year.
Correct. So perhaps we can look at the different instruments now that we have analyzed.
Yes. Right. So let's take a look at. Should we take a look at XAU, which is also the gold miners index, which is a trough-based analysis, and we've got some comments to make here about the FLDs. Let me turn those FLDs off quickly and zoom out and let's put on the semicircles. So here we have XAU. It's also an index of miners' shares, and you can see that the 14-year cycle had a trough here in 1986, I think that was, and then again in the year 2000. And you can see a really great M shape. I had to mention the M shapes. You can see a really great sort of M shape developing. You can see this typical cycle shape developing over here from that's the 2000 low coming up here. Here's the the 7-year cycle trough over here in 2008. And then of course we have that cycle developing from there. The important thing to note here initially is probably that we're getting exactly the same shape here, and we've got the same expectation. In this particular analysis, Sentient Trader has been so bold as to actually place that 14-year cycle trough right there, and let's zoom in and we can take a look. You see that the same sequence of failed or inverted cycles here with the 42-month cycle, and then the 14-month cycle, and then 30-week cycle. And see if I've got data here. Yes, got a bit more data there, and you can see Sentient Trader has already positioned the 14-year cycle trough over here, beginning of September. Now you have to be very careful, and I know John has something to say about this. You have to be very careful when you're approaching a really big trough. The fact that the software says that trough has formed doesn't necessarily mean it's the case. Okay, because Sentient reckons that there is enough evidence to place that trough there, but you do need to be a bit careful. What is recommended approach, John, as we get closer to this trough? How would you recommend sort of identifying that the trough has occurred and perhaps trading that?
Well, I think you know, for the long-term signal, I would probably look at the 15-week FLD as an important sign of something that's perhaps started. But there's actually a very simple, this market has been so bearish, there's a very simple way to know, and that is if the gold miners rally past 12 weeks, you would actually see something that hasn't happened in the last 4 years. In other words, the gold miners would have to rally past 12 weeks and not make a new low. And if you look and study the charts, that hasn't happened since 2011.
Okay, so yeah, so we'd be looking at a 12-week. Let me just adjust this chart slightly and measure 12 weeks. 12 weeks would be 84 days, something like that. Is that right? 12 times 7, yes. So we'd be looking for a rally for about 12 weeks as information that the miners are getting out of that really strong bear market. And there is the 15-week FLD that I've plotted on the chart, which would potentially be an initial indication that the turn had happened. You can see that price came up to the 15-week FLD, tracked along it, didn't manage to above it. It's poised now to potentially break up above it, but you always need to be careful when you're talking about such a big important trough that you don't jump to conclusions too quickly. There's something else very interesting to look at here. Go ahead.
So David, I wanted to add then the next cycle up, the 14-month cycle FLD is probably your bull bear line, and if the market were to rally up to that FLD and turn back down, then again you would have some hope but caution, because that's pretty much what this market has done for quite some time. In other words, it will fail at the 14-month FLD.
Okay, so we've been looking initially for a cross of the 15-week FLD. If price succeeds in breaking above that 15-week FLD, we can begin to think that maybe this really long cycle trough has formed. Then we would watch very carefully as price came up to the 14-month. Have I chosen the right cycle? Yes, the 14-month cycle FLD. If it succeeded in getting across there, then we could say, yes, that trough has formed. If, of course, that FLD provides resistance, then and it drops down, then we're probably still in a bear market. And as John is saying, this has been the pattern over this market has done. It has maybe broken the 15-week FLD, but it hasn't been able to above that 14-month FLD, and I can take it back, and you can see how that has been the case. Prices just never really succeeded in breaking up above that 14-month FLD.
So I think
Okay.
the BGMI gives you one view, David, but I think now we need to look at the other indices because they can appear quite different.
Right. So let's take a look at which workspace am I switching to now? Let's take a look at the. We want to have a look at the HUI, HUI index, also an index of gold miners. So that's NEM. Right, so here a HUI, HUI. And we can see the same pattern here, can't we, John?
Yes.
So we have a 14-year cycle. If I just zoom all the way out, you'll see Sentient Trader hasn't actually positioned a 40 cycle there because it believes it doesn't really have enough evidence. It's fairly obvious that the 14-year trough formed in the year 2000, as it did in the other markets that we've looked at. And at the moment we are, I think I positioned that correctly, there we go. And we are sitting almost 15 years into that cycle. And so we have pretty much exactly the same thing happening over here. And let me see if I change that to a weekly chart and do that.
And there's
since 2008.
Yeah, I want to add, David, there's a 7-year FLD, and I put that up there because the target for that has almost or more or less been met, which is to say that price can still go lower, but actually the price target for this FLD has actually been achieved. So it means, there's two things, right? You have to have the right phasing for that FLD and that target to be meaningful. And so in the end, we have achieved the target. Now the question is where will be the final low in price?
Right. So this is that target here. As price dropped down below the FLD, of course, you take an equal distance to the downside, and there's the target. I'm struggling to draw with this pen, but there is the target for that FLD cross. That target has been fulfilled, and there's another small detail. Hurst mentioned that FLDs tend to form peaks when you expect the market a trough. To draw a vertical line, I don't know why I'm struggling so much, but there we go. We have a peak in the FLD. So now is certainly a time to be looking for this trough in this is HUI, another one. But there is a subtle difference here. If I zoom all the way in here and take a look at this detail here, you're looking at one more. Is that one more 15-week cycle, or really one more 30-week cycle before the big trough in this particular?
Correct. And you can see Sentient is struggling with placing the current 30-year sorry, the current 30-week cycle, because you saw this peak in May, and now it's struggling to decide where that cycle low should be, and then that obviously would drive, where your next 15-week and 30-week cycles would then align and bottom. So the phasing and the cycle analysis is a little bit fuzzy here because in this index the price has seen such a sharp drop.
Right. Yes, we've seen this tremendously sharp drop over here, and as John was saying, this is the 30-week cycle trough, which Sentient Trader is having difficulty positioning. It can't work out where to put it. That's something that you do see when prices move very strongly in one direction or the other, whether upwards or downwards. All the shorter cycles are getting squashed, and it gets quite difficult to identify the correct position for those troughs. So there's a little bit of uncertainty in terms of this analysis. But here you can see from the nest of lows that the big trough is expected sort of one more hop away, and it's expected early next year.
Correct. And so and this is to go off of Harman's comment that all the larger cycles are hard down, and so this is a tricky market to trade on the long side until we see that important nest of lows.
Right. Yes, because those longer cycles are exerting so much force that to jump into a long trade prematurely would be a very dangerous thing to do. Shall we take a look at Newmont Mining, which is not an index but an actual gold mining stock? Here we go. This is the chart of Newmont Mining, and let me just zoom all the way out so we can take a good look at it. Okay.
I perhaps would add a comment, David. Jules made the comment about the S&P and the general stock market, and one of my views is that I don't think the precious metals market, or at least the gold miners, will perform that greatly to the upside until the overall stock market makes some kind of an important low here in the coming months. And so I would look for, in the S&P analysis, for an important low to form by early next year sometime, and I think the gold miners would be making their important low in a similar time frame.
Okay, fantastic. So we're speaking about something that's happened here. Let's just make that clear. We're not saying the 14-year cycle trough has formed. We're saying we need to be aware of it and stand by for it. And that the gold mining sector of the general stock market is likely to be a really good sector to get involved in soon when that 14-year cycle trough forms, because it is bouncing out of such an important trough.
Correct.
And so should we take a look at Newmont Mining, NEM? This is a gold mining stock, and we're seeing the same detail here, of course, as we were seeing in the index. But there are several very interesting points to be made about this. Let me just change this chart to a...
So there's two, before you change it, David?
Yes.
There are 2 points to be made. The FLD target for the 7-year cycle or 7.5-year cycle has been achieved for Newmont. So that doesn't mean to say that the price cannot exceed that target, but that target has already been achieved. And the second thing is, right, if you study the 7.5-year FLD, remember it's an offset by a half span of that cycle. That's what you're seeing in the red line. see how the 4-year cycle lines up with the dip in the FLD in the middle of the chart? Okay, so it's giving you guidance at times as to where to expect lows. And so if you study the FLD further to right than where the 4-year high and low was made, the last 4-year high and low was made, that time frame comes in early next year on the FLD, David. I mean to say on the FLD. Exactly.
Okay, yes. Okay, over
Yes.
here.
So if exactly. So I would expect that the low, whatever it forms, should arrive by that time. And so
Okay.
anytime between now and then.
Anytime between now and then, we're looking for an opportunity for Newmont Mining to turn up in a very big way.
Correct.
Okay, let me zoom in here onto chart and change the detail. Go to a daily chart. Let me see a weekly chart. There we go. Okay, so we're looking at, since the most recent 7-year cycle trough, we're looking at 6.92 years. So again, we're really approaching that 7-year mark. And since the most recent 42-month cycle, we're looking at 40.6 months have elapsed. So again, that cycle is really heading down towards its turning point. And let's zoom all the way in down here. Now, Newmont Mining is about 10% of the XAU index. Is that right?
Yes, correct.
It's included in that index, right?
So in this phasing, again, you can see that Sentient is struggling with placing the 30-week cycle because that 30-week cycle occurred at a peak virtually. And now
Right.
price is falling into the next 15-week cycle low, which is due imminently. It may have already occurred here in September. So I would expect at least a bounce from here to some kind of a peak within the next few weeks, and likely then see price fall then to a low. That would be my my best guess in terms of what how this bear market should end.
Right. So as with the index we were looking at, the Huey, we're looking at one more bounce before we see that final drop into the very big low. We turn the semicircles off, and we can just have a look at that. There we go. So we're looking at the 15-week cycle trough forming now. Perhaps it has just formed, and here's the nest of lows for the 15-week cycle trough. Perhaps it formed somewhere over here. We're looking at a bounce up, and then a move down into this trough.
Interesting that we've seen a cycle failure at the 4-year, the 14-month, and the 30-week, and it would not surprise me to see a failure on this 15-week cycle. In other words, we go to a peak very soon in the next next 2 or 3 weeks or whatever, and then we head down to new lows. that would be probably a fitting way to end this current this bear market.
Right. So again, we're seeing a sequence of those failed cycles, which is a peak forming pretty much when we would have expected the trough, and so we would then get to a peak fairly soon. Not a very impressive peak, not a big bounce up the 15-week cycle, and then then a strong move down for the move down into that 14-year cycle low. I see a few questions. Let me just respond to some of those that I can, and I'll ask John to respond to the others. Somebody asked, I think it was Marcus, said, could I put up the commonality, the new composite model line. I can't actually, Marcus, because I haven't updated these charts to the new version. I'm working with the standard, the current version, so you can't actually look at that on these charts. But it'll be an interesting thing that we can do in the next few weeks as we continue to watch this market. And Sid says gold miners have historically led gold a bit out of major lows. Now, John, you were saying something similar to me the other day. What do you to be the relationship between the gold miners and their movement and the gold price itself?
So in response to that, I mean, you clearly saw that type of price action out of the 2000 low, and I would expect the same thing here as well. So I would expect the miners to start their move, perhaps even by late this year, maybe December. It could be the low, and we get a rally, and gold may still be retesting its low next year before it really gets going. It's hard to predict that kind of thing, but that is typically what I would expect. And let's make sure that we finish off with a couple of those charts I left with you this morning, David, particularly the ratio of the BGMI to the spot gold index, because
Yeah,
that tells you.
That's a great chart. Let me clear. Okay. And so these are the charts we've looked at. We looked at them in the workspaces. Let me get on to that. Okay, here we are. Tell me about this chart.
Okay, right. So I was looking at the BGMI and studying the price and the pattern and the cycles, and then I remembered I was looking at the ratios of the XAU and the UE to spot gold, and there's been a terrific move in these ratios in the last few years. And then I found this chart, which is the BGMI index ratio to spot gold. And you can see that in this ratio, we haven't seen these levels since the 1940s. So the gold miners have vastly underperformed gold, and you are seeing a major low forming, I guess, perhaps in this ratio. Surprising how this ratio is below the level of the 2000 low in the sector.
Right, so here's the 2000 low.
Yeah. So that really brings up the question, what will we see out of this next 7-year and 14-year cycle? And that's probably I think a question open for debate, because I haven't really formed a definite opinion in terms of what the long term holds for the sector. But I would expect a fairly strong move over the next few years out of this low. Whether that continues beyond say 7 years, I don't know. But certainly the trade and this market will be getting very interesting to trade as we approach the coming nest of lows.
Right, so I'm just trying to bring up a chart that will allow us to look at the really long-term picture here, and just finish things off by considering that really big question in terms of the next 7-year cycle. So we're looking at a big bounce here. This is the 14-year cycle trough. So we're looking at a big bounce, and probably going to see a fairly bullish 7 years, you're saying, John. So it should have a late-ish peak and end up carrying prices a little bit higher for the next 7 years.
I think certainly in terms of a risk reward trade, if you look at the historical price and the 7-year cycle, you've almost always seen a good long trade out of that cycle, regardless of where you were looking, where you were finding that low in the 14-year phasing. So that's why I think you have to appreciate how bearish and how strong this market has been moving in the last 4 years, and recognize the recognize the opportunity once it arrives.
Right. So that's our takeaway. That's our conclusion. Is there's a market that has been dropping dramatically for 4 years, and it's approaching an important turning point. And so we need to look out for that turning point and look at long trades, but doing so cautiously.
Correct.
Well,
so
thank you very much. Yeah.
So I just wanted to say thank you, David, for having me and allowing me to share some of these charts and the analysis. It's something I've wanted to post for some time, but I think it presents itself much better in this type of a format in this webinar, as you can more or less walk through various aspects of the analysis.
Absolutely, and thank you very much for joining us, John. Thank you for all the work you've put into this, and for breaking your usual silent practice and coming out and speaking to us. And thank you for sharing your analysis. So, if there are any final questions, we'd be happy to answer them, but it's time for us to wrap up today's webinar. Thank you very much, everybody, for joining us, and thank you, as always, for your interest in Hurst Cycles and Sentient Trader, and make sure that you look out for the big turn on its way in this particular market. And we'll be sure to revisit all of these analyses. We've completed a sort of a section, a bit of a path through these webinars, starting with the US stock markets, and we've spoken about euro, US dollar, crude oil. Now we've looked at gold, and my intention is that we're going to start looping back around, and we're going to come back and we're going to revisit analyses, of course, on a fairly regular basis. Perhaps a month or so, we're going to come back and revisit analyses, perhaps every 2 months, and take a look at updates to the analysis and see how things are progressing. Before I finally sign off, let me just see if there is anything particular that I have missed out. And let me see. I see Harman has asked why the 7-year cycle. Harman, perhaps at the beginning of, where am I? I'm switching windows here. At the beginning of today's webinar, we spoke about the nominal model that we are using in gold and discussed how that nominal model was derived. And instead of Hurst's normal 9-year cycle, a 7 to 7.5, perhaps 8-year cycle was found. And so that's the nominal model that we've used in all of these analyses. If you missed that, then of course the recording will be available. You'll be able to go back and look at that and see how that was derived. And let me see, I've got a few other questions here. From should we reverse 1/x chart when we trade commodities? I think perhaps, Piotr, what you're getting to there is yeah, should we inverse the chart? In other words, look at the inverse of the price. I spoke about this, I think it was in the webinar 2 weeks ago, the principle of synchronicity, the concept that, in my opinion, peaks in synchronized. The same is true, as John mentioned today, in gold and in precious metals. And in stocks, the troughs are synchronized. So yes, you could either invert your prices, which is a horribly complex thing to do, if you're then going to start making trading decisions, or you just tell Trader to perform an inverted analysis to get it to perform a peak. So I hope that that answers that question. David, trading Hurst, why does the first 42-month cycle have 3 small cycles looking like it will have 4? I think that might have been a question from a way back, but I think I know the chart you're speaking about, David. It's is it the BGMI? It's because we have a staggered nest of lows. Is the quick answer, and in fact, I made the mistake of assuming that the synchronized trough was the wrong one, but it's a staggered nest. Here we go. This is it over here, and so let me just take this back a little bit. Here we go. This is the answer to your question. Can you see these little grey boxes above the circle and whiskers? Those grey boxes show you which cycle is linked to the next one up, and so it looks as if though the cycles are forming a nest of lows over here, but in fact they're not, because there's no grey box linking that 18-month, 14-month to 2-month cycle over there. The box is over there. So in fact, the correct nest of lows is from that cycle to that cycle to that cycle to that cycle. Okay, so that's why you get that strange, looks as if though there are 4 cycles there. And Robin from Peak Analysis, I can't unfortunately because I haven't upgraded these workspaces to the beta version, although I will be doing that this week, you can be certain, and watching it. Sid asked, would a bit of repinning allow the 7.5-year and 50-month cycle line up better with the 9-year, which bought quite recently? Yes, perhaps if you did a bit of pinning and worked with that, then perhaps it would, Sid. It would be something to look at. And Marcus says the cycle failure business bothers him, makes him feel like this market doesn't reliably follow her cycle methods. Concept of cycle failures is an important concept because not all cycles bounce with perfect regularity, and I would say it shouldn't bother you. It's something you need to embrace. Once you learn to identify it and recognize it, it will stop bothering you because you can say, okay, I understand it, and you can move on. Hopefully that gives you some comfort. And Robin, I missed the first part of the webinar. I want to know how many days in this 14-year cycle nominal model so we can replicate it. Okay, I'll tell you what I'll do for the nominal model. Let me bring that nominal model up on the screen, and you can take a look at that. And in fact, what we will do is we will share this nominal model. 14-year cycle, number of days, it's 5,076.98 days, 5,077 days. Robin, that's how many days there are in the 14-year cycle according to this nominal model. And it says gold rally means SPX is going to find a low. Interesting question. Not necessarily is the full answer. The inverse correlation between gold and stock market is not a constant thing. It's not a proven thing. So not necessarily, but generally when gold moves up, we expect stocks to move down. But it's more complex than that, and more importantly, you should watch the cycle separately and see how that goes. Okay, thank you very much, everybody. I hope I've managed to answer as many of your questions as possible, and thank you so much for joining us. Thank you once again to John for joining me on today's webinar. It's been fantastic to have you with me. The isolation of speaking to my computer all on my own every week in these webinars. So thank you so much, John, and thank you to all of you. I wish you great trading, and I look forward to seeing you next week. I am going to have a guest with me again next week. I'm very pleased. So more about that in the days to come. I look forward to seeing you next week, and in the meantime, wish you, of course, profitable trading.